Hi, everyone. Thanks for joining us for this next panel, which I hope will be as lively as the last one. That was fun. So I am Deborah Solomon. I'm the economics editor at the New York Times, and I'm very glad to be here moderating this panel with this esteemed group. I will quickly introduce folks since you probably already know them if you're here, but obviously we have former Fed Chair Janet Yellen, who was at the Fed leading us through 2014 to 2018, and obviously spent the crisis at the Federal Reserve Bank of San Francisco in the midst of a lot of the housing issues in California. We have Governor Lael Brainerd, who is in the middle of today's crisis, but also has been a governor at the Fed for a while and was at Treasury during, I believe, the last crisis when the new administration took over, working for Tim Geithner as the deputy secretary. Jeremy Stein, a former Fed governor as well, who has written a lot about financial stability issues and is now the chair of the economics department at Harvard. And Dennis Kelleher, who is at Better Markets now, who advocates for financial reform and worked in the Senate, I believe, during the Dodd-Frank debate. So with that, we're going to get started. This panel is looking at whether Dodd-Frank has reined in systemic risk, which is very timely given that there have been a number of developments this week that have brought that question to the fore, not to mention the last 3 months, are we in month 3, I'm not sure, of the crisis and how the financial system has been tested. I guess I want to start with Governor Brainerd, mainly because you are in the middle of this, and last week, we saw the Fed release the results of the latest stress tests, which included these 3 scenarios that put the banks through the sort of severe kind of recessions that we might see, whether it's a double dip, a V, a W, or a U, whatever your alphabet letter of choice is. And what we saw was that, some of the banks, about a quarter of them, would have come close to breaching minimum capital levels in a double dip scenario. And their loan losses would be more severe than they were in even 2008. Obviously, the Fed took some steps. They capped dividends at second quarter levels and prohibited any kind of buybacks in the third quarter. The FDIC, I think on Monday, yesterday, basically said that banks, remain, that there are big risks to banks that remain in terms of credit risk, interest rate risk. I'm curious to hear from you. Do you think that the banking system is better off than it was, and has Dodd-Frank reined in systemic risk at the banks, and is there more that the Fed should do at this moment to make sure that these banks can survive what is undoubtedly the most severe crisis we've witnessed in our lifetimes?
Well, good morning, and thanks for the question. Yeah, so I think it is important to note that as a result of Dodd-Frank and the enhanced prudential standards that were put in place by the board, large banks actually did work hard over the last decade to build strong capital and liquidity buffers and to improve their risk management. And I actually think those reforms were vital in positioning banks to respond to COVID. And they were able, as a result, unlike the last financial crisis, to continue lending to households and businesses, to work with their customers who need assistance, and to intermediate financial transactions. But my own view is that it is a mistake to weaken core financial reforms at a time when they're clearly proving their value in the first serious test since the financial crisis. As you've noted, just last week, most of the largest banks were actually given the green light to continue with dividend payouts, despite the substantial likelihood that they could need larger capital buffers to absorb losses under plausible paths for the economy. And with few exceptions, the affected banks have announced plans to continue dividends at the same level. And of course, these kinds of payouts raise the risk that banks will need to raise capital or curtail credit at a challenging time in the recovery.
Chair Yellen, I want to ask you a question. I don't know if you watched the last panel, but Andrew Olmam, who recently left the Council of Economic Advisors, said that that regulators were already on the path to increasing capital levels, and that Dodd-Frank was not necessary in term, that it wasn't needed in order to get the regulators to increase capital levels at banks. However, what we've seen, and what I think Governor Brainerd had alluded to, is that we're seeing some weakening of those capital standards at this moment under this administration. In part, some of this has been done, under the guise of being temporary relief for the banks. But are you concerned that we're going in the opposite direction of where we should be? I mean, obviously, you don't want to create more stress for banks at this moment, but it does seem like we are weakening capital levels. And I'm wondering what your prescription would be to make sure that we can get through this crisis and the next crisis.
Well, I think it's true that the Fed was taking steps and the other bank regulators to put in place stress testing and increase capital standards. But I think that Dodd-Frank was extremely useful in providing a roadmap and a clear mandate for a host of changes that were put in place to increase the safety and soundness of banks. In addition to the capital and liquidity requirements and the stress tests, I think living wills, resolution planning, TLAC requirements, the things that were in Dodd-Frank really have succeeded in making the banking system stronger. The Fed always had the notion that there should be tailoring of capital and liquidity requirements to the systemic footprint of particular banking organizations. That's something that I agreed with, and I think most of my colleagues did. And some of the changes over the last 3 years or so that have been put in place are appropriate in tailoring requirements in that way. But there are a number of things that, in my view, have gone too far. Places where, for example, banks over $250 billion had diminished liquidity requirements, capital requirements, changes in a number of cases. Lael dissented, and I think if you look through the record and look at her dissents, you can see cases where regulatory relief went beyond what appropriate tailoring would require. Now, you asked about what the Fed's doing to ease capital rules now. I do think it makes sense when there's a crisis for the buffers that firms have built to be run down, to be released when the system is under pressure. And a lot of what the Fed's done since the onset of the crisis involves exactly that, encouraging banks to lend. There was a change in the supplementary leverage ratio to include treasuries and bank reserves. I'm not very enthusiastic about excluding treasuries, but with respect to bank reserves, it was something I worried would complicate the conduct of monetary policy. And I think it became quite worrisome in recent months when the Fed was vastly, by trillions of dollars, increasing reserves in the banking system. So running down buffers in a crisis, completely appropriate, but I definitely agree with Lael, and my guess is the others on this panel, that allowing firms to pay dividends at a time when the system is under stress like this is really inappropriate. It's not something I would have been supportive of.
Jeremy, I'm curious to hear your view on that, but also, I wanted to mention that the same day that the Fed basically warned that banks remain vulnerable to a severe downturn, you had regulators easing two other Dodd-Frank rules, the inter-affiliate swaps margin rule, which I know everybody knows what that is, but it's a complicated rule, but it's important, and the Volcker rule, obviously allowing for covered funds, banks to invest in certain hedge funds and private equity funds. Obviously, Governor Brainerd had dissented on the Volcker rules covered fund piece, but I'm curious what you see as the trajectory of regulation at this moment, Jeremy, and also Dennis. I'd love to hear you jump in on this as well. Do you think that that we are doing sort of an appropriate tailoring, or has it gone too far? Are you worried that we are destabilizing key tenets of the last the last lessons we learned from the last crisis? I think you're muted.
Yeah, at the risk of being sort of too agreeable with my fellow panelists, I think I'm sort of in a pretty similar place. I mean, like Janet, obviously, there was a tremendous amount of new regulation put in place 10 years ago, and there's no way everything is going to be completely right, and we're going to learn stuff. So of course it makes sense to adapt and to tailor. And actually, even with respect to Volcker, not so much with the private equity piece, but I always sort of had my problems with Volcker generally, with the idea that you're going to sort of tell the difference between speculation and market making. I would have preferred to address that with sort of very heavy capital requirements on those activities. But I really do agree with the proposition that the overall, that if you pick out any one of these things, many of them seems reasonable or almost reasonable or benign, but the overall direction of travel is worrisome. And I also think, one of the lessons I've learned, it's not even just the rules, which are the most visible thing. I think if anything, we've learned the lesson that personnel really is policy. And my biggest concerns have been not just with the rules, but for example, stress testing. If you had asked me 2-3 years ago what one of the biggest good things to come out of Dodd-Frank was, I would have said the stress test. Look, the 2009 SCAP was incredibly important. It was too late, but it was a really incredible turning point in the crisis. And I thought, well, the great virtue of doing the stress tests every year is that you build the muscle memory and the institutional resolve so that when the next time comes and we need to aggressively recapitalize the banking system, shut off dividends, that we'll have a process that basically allows us to do that. And I'm sorry to say, my sort of hope for the stress tests as that kind of, crisis wartime device has faded considerably. And that's not in the rules. It's not in the sort of formal regulation. It's in sort of how it's implemented, how it's thought about. I think it's very worrisome. I think the stress test has become something of a compliance exercise. And one of the really disheartening things I hear, this has become a bit of a meme from the banking lobby, is that somehow, because we had a stress test last year, and in the stress scenario last year, we envisioned the banks paying dividends for 9 quarters, that somehow because they passed a year ago under that purely hypothetical scenario, that it would somehow be damaging to the Fed's credibility or a violation of some kind of transparency principle if we were to shut off dividends now. To me, that's a complete subversion of the process. It's as if we said, 6 months ago, the Fed had their dot plot for monetary policy with higher interest rates. And because there was a crisis and they cut interest rates, that they've somehow violated some principle of credibility or transparency. But somehow in the process of just going through this over the last several years, the expectations for what it can do or what it should appropriately do have changed. So, I agree with and applaud Lael's dissent on this. I think it was a real missed opportunity to both curb payouts and to provide some transparency, which was, again, a very important part of the 2009 thing. So I'm certainly, and again, it's not on the rule, it's supervision. What kind of a message is being sent to supervisors in the field, which are an important part and complement the rules, I think, in an important way. So I worry about that whole kind of positioning and attitude as much as I may be worried about some of the individual and more visible regulatory changes, be they swaps or Volcker or any of that.
Dennis, can you give us your thoughts? In particular, I'm curious, can you talk a little bit about why it matters if the banks have capital? Who suffers first if the banks sort of, run down their cushions and have nothing left? Who do they stop? Do they stop lending, or what do they do? Do they stop paying dividends, or do they stop lending? What's sort of the impact for the real world?
Well, the good news is we don't have to guess. We can actually just look at 2008. And you look at 40 times leverage, if not more, of the systemically significant banks running into 2008. And you look at, and I'll agree with Andrew on this, the failures of the regulators, including prominently the Fed before 2008, of letting those banks run down their capital cushions. In '08, not only did the banks continue their capital distributions until Lehman collapsed, they continued them into December of '08. It's shocking that they were allowed to do that. And so the only thing standing between a failing bank and financial chaos and contagion is a taxpayer bailout. It's that simple. If you have capital, then you're more likely to be able to deal with your credit losses, deal with the crisis, deal with the downturn, and not have to stick your hands in the taxpayer pockets. And we saw exactly that happen in '08. So the question is, who in their right mind would allow that to happen now? I mean, you have the Fed chair testifying right now. I have a lot of respect for Jay, testifying right now about, quote, the extraordinary uncertainty, close quote, facing this country and our banking system. And yet, at the same time, the Fed is allowing the biggest banks in the country to reduce their capital cushions. It's nonsensical. And history is going to be an incredibly harsh judge here if they don't have the good luck of the small percentage that they're not going to require more capital pretty quickly. And it's really too bad, because I do think that there's no question Dodd-Frank reined in systemic risk. In fact, Better Markets is putting out a white paper next week called No Financial Crash Yet, thanks to Dodd-Frank and the banking reforms. Frankly, thanks to the three other panelists here and Chair Yellen's leadership. There was a very good job done under the Obama administration of, and let's remember this point, forcing the banks to become more resilient. None of that was done voluntarily or willingly. In fact, it was done over their aggressive, fierce opposition. Now, I always kind of laugh. The banking CEOs now say, we're so strong, we can help support the economy. We're glad to do that. Well, if all their lobbyists have been successful, they wouldn't be able to do that. They're able to do that because these three regulators and others force them to build up their capital and their liquidity. And, when they say, oh, well, they were going to do it anyway because Dodd-Frank was irrelevant to it. Well, they were not in different universes. The momentum behind financial reform in Dodd-Frank and the obviousness of the deficiencies of capital, liquidity, stress testing, resolution planning down the line were obvious. And the Fed isn't going to sit there and say, well, let's just wait until we get a law. They did their job. They started parallel with the legislative process of getting these banks more resilient. And then Dodd-Frank happened on a parallel track, creating the authorities' mandates that required them and the other regulators to do it. And you're also right. I agree. And as Jeremy says, I hate to be too agreeable, but I mean, how can you, in the middle of an unprecedented pandemic, where the future is unbelievably unknowable. You can pick your letter of the alphabet to how this is going to play out, but most of those play out pretty badly. And yet, the banking regulators just took $40 billion out of the margin in the derivatives market, 1/3 of the entire amount of the margin in the derivatives market, which is a capital cushion, right? Which is a protection. It's like the down payment on your house. And so you take that and the Volcker rule. I disagree with Jeremy here. Eliminating proprietary trading is incredibly important to the safety, soundness, and resilience of the biggest banks. And taxpayers really shouldn't be backing the gambling of big Wall Street banks, because what happens is the banks get bailed out, the American people get the bill. I mean, 13 months after Lehman crashed, the U6 rate, the larger unemployment rate in the United States, was 17%. 27 million Americans within 13 months after the Lehman crash were out of work. Actually, many were heads of households. That impacted almost 50 million Americans. That's who pays the price for regulatory failures to make banks stay strong in good times, and make sure they stay strong in bad times, so that the American people don't have to both suffer the economic calamity they caused, but also have to pay to bail them out. That's what's at stake.
One of the things that this crisis seems to have exposed is that, the banks are well capitalized and, they haven't, we're not having another Lehman right now. They are, they're for now, okay. The non-bank sector, however, there seems to still be these pockets, these areas, these significant areas of risk and weakness that we've seen the Fed have to go to extraordinary lengths in this crisis to prop up. I mean, within 48 hours of things going haywire, they had to intervene in the treasury markets. They had to intervene in the, to help the hedge funds that had these, these basis trades that they needed to unwind. The money market funds, as was discussed on the last panel. Chair Yellen, I'm wondering if you could talk a little bit about has there been a failure of regulation to address, areas of risk that regulators have known about but have, not really done much about, and was Dodd-Frank an avenue to get those areas under federal oversight, and did we miss that opportunity?
That's an important question. I think most of the problems that you just mentioned were areas of risk that were well known before the pandemic and weren't addressed. Some of them were on FSOC's to-do list, but then were dropped by the Trump administration. A couple of examples. You mentioned hedge funds. Well, FSOC formed a working group on hedge funds, and that group found that there were a few hedge funds that had taken on a lot of leverage. The working group recommended follow-up. As far as I can tell, that working group was disbanded. The pandemic showed that the risks were very real and serious. A group of funds, these funds that had taken on extreme leverage, engaging in basis trades in the Treasury and Treasury futures market. When volatility increased in March, they faced margin calls. They sold off massive quantities of treasuries. Well, it only required $2 trillion worth of Fed purchases of treasuries to deal with that. Had the Fed not done that, we probably would have had another long-term capital management type episode. Let's take a second area, asset management. FSOC had identified dangers relating to open-end mutual funds that offer daily liquidity while investing in less liquid assets. That would include high-yield corporate bond funds, leveraged loan funds. They experienced large outflows in March. Again, the Fed stepped in with establishment of the prime and secondary corporate credit facilities to relieve those strains. But these were things that were well known. Money market funds, another example. It was almost impossible for FSOC to get, that was top of FSOC's to-do list when it was formed in 2010. It was incredibly difficult for FSOC to persuade the SEC to address systemic risks in these funds. I very well remember a speech by an SEC commissioner who said, this simply isn't our mandate. And I do think a big problem here is that FSOC was not given any powers of its own to address things like money market reform or problems in asset management or hedge funds. And the SEC and other regulators also didn't have any change in their mandates that would force them to address systemic risk. And this commissioner gave a speech saying, this simply isn't our job. Well, in the end, they did do something, but they also did something that almost all economists, including most people in the Fed, were very unhappy about. They allowed funds or insisted that they impose gates and redemption fees once liquidity fell below a minimum. Most economists thought that the erection of gates by one fund would cause outflows and contagion as people tried to avoid having that happen to them. And I think that's exactly what happened. And finally, I think the last area that I would point to is leverage lending. Leverage lending skyrocketed in the years before the pandemic. Non-financial corporate debt rose to levels we haven't seen relative to income in the United States. Many regulators, including me, expressed concern about deteriorating underwriting standards and rapid growth. And there were a lot of different reasons to worry about this development. One of them, I think, is that firms that have overhangs of debt are usually reluctant to hire and invest. And personally, I think that's something that would make the current downturn deeper and more longer lasting. So, a failure to address many of these were things that were known, they weren't addressed. But what was the problem? I think in part it's that FSOC doesn't really have any powers of its own to regulate activities that give rise to systemic risk, only really designation, and that's been neutered by the courts and FSOC itself. The agencies weren't given explicit financial stability mandates. The Fed was sort of given such a mandate, but only to make the systemic banks safer. If there are developments like leverage lending that banks are engaging in that pose risk to the economy and the financial system, but aren't major concerns with respect to safety and soundness of the banks, it's not obvious to me that the Fed has an explicit mandate to do something. And I would say the one tool that we did use to address leverage lending, we issued supervisory guidelines in 2013. That was a weak tool in intervention to start with, and then Congress, the GAO, the OCC, and others pushed back. So there really are problems here, I think, in the powers created by Dodd-Frank, and we've seen it all blow up, except for the Fed intervention that's saved us from a financial crisis.
Well, Governor Brainerd, you chair the Financial Stability Committee at the Fed, and obviously the Fed has mentioned in many of their reports some of these risks that Chair Yellen has talked about, in particular hedge fund leverage loans. The Fed has been put in this position, which, having covered the 2008 crisis is kind of amazing. Back then, there was a lot of criticism of the Fed, and there was this effort, obviously, to take away their power. But now the Fed has been sort of the last fireman at the party, having to go in and fix all this stuff. Do you think there is, coming out of this crisis, do we need to figure out a new way to address risks outside the banking sector so that the Fed is not constantly put in this position? Or do you think that this is just, this is not the kind of thing you can ever really prevent through regulation or oversight? This is just, Wall Street being Wall Street.
No, I absolutely think that the kinds of risks that Janet talked about in the non-bank financial sector were not only predictable, but well documented and can be subject to an expansion of the regulatory perimeter. I think we've now seen not once, but twice in only 11 years, shocks that were in no way anticipated, that were in what economists call the tail of the distribution. And we've seen the demonstration now twice of how important financial stability is for the economic security of American families and the ability of our businesses to invest and expand. So I think from that, the most important lesson is that you can't predict shocks, and that financial stability authorities and regulators have to be wary about developing a false sense of security. And that's precisely why Dodd-Frank was focused on making the financial system more resilient. And that was the entire financial system. And it's important also in our financial stability work, which you noted, our focus is not trying to predict shocks. They're inherently difficult to predict, but trying to highlight and address where we can the potential vulnerabilities. So funding markets are still fragile, and we have been noting that in financial stability reports. Banks, shadow banks, or non-financial firms that use short-term holding to take longer-term risks without an adequate liquidity backstop still pose risks. And we saw that with the money market fund, prime money market fund outflows that we saw in March of 2020. And you're right, the Fed came in to shore up those markets. It is true that open-ended funds, where you see a concentration of assets with low liquidity, also are an area that have been called out repeatedly in financial stability analyses. And there too, there has been really no movement to address those kinds of activities from a prudential or even from a macroprudential perspective. We've also, as Janet noted, the nature of capital markets trading has changed a great deal. And there has been a lot of financial stability oversight of those changes. Now, there are some areas that we have seen important changes. The enhanced prudential standards for the banks we've already talked about. The designation of financial market utilities has been extremely important, and we saw those platforms functioning well during a period of extreme volatility during the period of March. But more broadly, FSOC non-bank designation power really has been weakened very substantially. And I don't see that we have made much progress or seen much progress on activities-based regulation.
Jeremy, talk a little bit about the FSOC. You know, the last panel discussed it a bit, but this was supposed to be, you know, and I agree with Chair Yellen that it doesn't have a lot of power, but, you know, as Governor Brainerd said, they can designate non-bank financial firms as systemically important. They're supposed to be sort of the connective tissue between all of these agencies that were not discussing or coordinating before the last crisis to try to make sure that everybody is sort of seeing the risks that are out there and hopefully doing something about it, although it is up to the individual agencies. Has the FSOC, you know, been a useful tool? Has it been, you know, has it helped to make the financial system safer, or was it basically just an exercise in futility because it's become such a political football that, you know, depending on the administration, you can decide what the priorities are for any given chair, you know, to pursue?
So let me sort of sidestep your most direct part of your question, which is, you know, I agree with a lot of what Janet said about the weaknesses or the failings of the FSOC. And I agree, you know, totally with sort of the diagnoses of, you know, we didn't do the kinds of things we should have done with respect to, say, open-end bond funds and the like. But I guess I want to sound a slightly more pessimistic note in the sense that, look, I would like to do many of the same things that I think my fellow panelists would like to do, but I think it's, in some cases, it's really hard. And, you know, it was the FSOC's job and the FSOC didn't get it done, but I think it would be hard, you know, it's very hard to do regulation of the non-bank part of a very sort of innovative capital markets dominated economy. So, you know, you can criticize the FSOC or the SEC for being unsuccessful and slow with money market funds. I mean, for God's sake, they kind of were the ones that nearly blew up the world last time. So if you couldn't figure that out, it's pretty bad. But, you know, think a little bit about how the world of, you know, rapid growth of leveraged lending, a lot of this being held by these open-end vehicles. So I remember discussions in 2012, 13, where people were saying, well, geez, that's better than like repo financing of corporate bonds. It isn't leverage. And like in a market economy, if the investors in mutual funds lose money, like, isn't that capitalism? Well, of course, I think the better analogy would be if it's got like illiquid loans on the left-hand side of the balance sheet and it's got daily liquidity on the right-hand side, like that kind of looks like a bank and you could kind of have some problems. But, you know, it was not obvious and the industry was able to point to the historical fact that that vehicle had not as of yet brought down the economy. So it's a bit of a leap for any regulator, even a sort of well empowered one, to aggressively go after something that we have the foresight to think about as a problem, but has yet not manifested as a problem. And then as Janet pointed out, even this time, thanks to the Fed being able to intervene very aggressively, they still haven't blown up the world. So I think it's just hard. I think, you know, and of course I want to do better in all the ways that everybody else wants to do better. But I think at some point we also have to think about how do we make policy and how do we sort of think about a world where we're just going to be pretty limited We can surely do better with the banks. We can surely do better with the stress testing, all the things we talk about. But there's just going to be, this is a world where there's a tremendous amount of innovation, and last time's problem sort of morphs itself into a somewhat different version this time. And given the way authorities of regulators are kind of distributed, what used to be a problem in the banks is now a problem in the bond funds. And it's deeply hard. And, then you get to uncomfortable questions about, in a world where we just have to admit that this kind of regulation is deeply imperfect, what are the other tools we can bring to bear?
It's just not that hard. Come on. I mean, look, you have a banking sector and you have a shadow banking sector. You have a heavily regulated banking sector and a relatively unregulated shadow banking sector. So you have a migration of risk from the costly banking sector to the shadow banking sector. And the idea behind FSOC, as well as some other shadow banking reforms in Dodd-Frank, like derivatives, importantly, was to try and eliminate the regulatory arbitrage, which is primarily what is driving this. This is not a mystery. This is not just innovation. I wouldn't agree completely with Paul Volcker about the ATM being the only worthwhile innovation. On the other hand, most of innovation is created complexity for the purpose of regulatory arbitrage, to externalize the cost and shift them to taxpayers. And the job of regulators, whether it's the non-banking system or the banking system, is to stay one step ahead of that and protect the system and protect the public interest. And I disagree that it's all that hard. It's actually pretty obvious what's going on. Anybody who didn't know what was going to happen with money market funds could read, 6 or 7 of Better Markets comment letters on this. It happened in 2008. They didn't fix it. It was obvious they didn't fix it. FSOC under Chairman/Secretary Geithner tried to move the SEC on that, although that's a poster child in regulatory capture. That's not a mystery what to do there. That's not difficult. That's the political will to follow the law and prioritize the public interest, period, full stop. Now, it doesn't mean that FSOC's perfect. FSOC is a classic example of a horse that would, a camel is a horse that's made by committee, right? And so there's a lot of compromises that have to go in. I think, Chris Dodd referred to this earlier. The Dodd-Frank law isn't perfect, but it is the best law that the political process could produce at the time. And it gave FSOC plenty of authority. And frankly, the Fed has plenty of authority. Chair Yellen refers to the guidance on leverage lending, and that's what they had to do. But let's look at what happened to leverage lending before the guidance and after the guidance. It dropped precipitously after the guidance. So you can say the Fed didn't really have any authority, but the truth is every time the Fed opens its mouth, every bank in America pays attention. And they don't go to the statute and say, did they exactly have that authority? Now, that doesn't mean they should ignore that or think that it isn't there, but they have plenty of authority to get the industry to do what it should do. And almost always, they've got the specific statutory authority, or they've got the supervisory authority, and they've got numerous tools to do it. FSOC does too. Now, I'm not in any way suggesting it's perfect, or that it's enough, or that it's clear, or that it couldn't be better. Absolutely could. But FSOC got off to a very slow start, made some big mistakes in the beginning, notwithstanding best efforts in good faith. I mean, when you look at the list of companies that got bailed out in 2008 in the shadow banking system, you look at them, the long, long, long list. And, you all know them well because you were sending the checks to them, trillions of dollars in 2008. And what does FSOC do when they're supposed to regulate the shadow banking system? Okay, AIG, obvious. GE, also obvious. And look at the rest of the list. What happens? They designate 2 insurance companies. And it took them how many years to write their procedures to figure out what they were going to do or how they were going to do it? I mean, by the time they got their act together, all the momentum and all the kind of public ability to get things done were largely dissipated. And so they ended up not doing a very good job. And they really laid the groundwork for the Trump administration to come in and flat out kill it. I mean, the FSOC, is a zombie. Right? It's there in form, not in reality. They both killed the designation authority by by working with the private sector in the litigation to kill the litigation. So the DC Circuit couldn't even review a grossly groundless decision by a district court. And that the FSOC's going to have to live with that. But at the same time, moving to say, look, we're only going to do designation of activities, that may be fine. But why you wouldn't use all your authority on the entity designation side and on the activity designation side and use OFR and use all the tools and powers you have. OFR is one of the most important, powerful, independent agencies we created in Dodd-Frank, and we created it for a reason. And that too has basically been neutered from the beginning. Let's make the
just now, because we only have a few minutes left, but what I want, because I want to ask, I mean, this came out of the last crisis, right? We're in a new crisis. And I'm curious, Governor Brainerd, do you see any impetus for ways to curtail risks that we know exist and that have exacerbated some of the problems that we're seeing in this, downturn? Do you see any momentum, or what would you suggest we do coming out of this to try to make the financial system more resilient? Or, to play devil's advocate, is that never going to happen? And are we just going to have to rely on the Fed to basically bail out every hedge fund, every ETF fund, that gets into trouble because there is no political will to really address some of these problems? I think you're muted.
Can you hear me now?
Yeah. Yes.
Right. So here, my most immediate concern is there is considerable uncertainty facing the economy. We have seen earlier than expected relaxation of social distancing, which is having a positive effect. The economy seems to have bottomed out. And we're seeing some encouraging signs of a recovery. On the other hand, we're seeing some resurgence of the virus. So right now, my focus is on steering through a very uncertain recovery and continuing to provide necessary support to American households, to American businesses. I do think that very quickly, once we have come through this very challenging moment, it will be a time to look back and make the necessary changes to those areas where the work of financial reform is incomplete. And to be fair, there will always be new areas. And so as regulators, our job is to do what's not always popular to help the financial institutions prepare for risks that they're not anticipating, that may not be able to be anticipated because we know that those risks will materialize, and we want them to be resilient.
Chair Yellen, I'm just curious, just quickly, do you agree that we should reflect and come out of this with newfound regulatory zeal, or do you think that given the current environment that we're in, that this is just going to be a perpetual game of cat and mouse?
Well, I think when this immediate crisis is over, and I agree with Lael, we should focus on getting through this and doing what we need to recover. But when we do, I think we should reflect on the lessons from the crisis. I personally think we need a new Dodd-Frank, that we need to change the structure of FSOC and build up its powers to be able to deal more effectively with all of the problems that exist in the shadow banking sector. I mean, Dennis said the Fed has powers and there are things we can do, and FSOC had some things it could do. And that's true, but I think the structure is inherently flawed. I think the agencies need to have a definite financial stability mandate, and FSOC needs, as Dennis said, both the power to deal with individual firms, non-banking firms that pose systemic risk, which it's now completely neutered. It'll be almost impossible to use, but also it needs the power to regulate activities. And that would be my view coming when this is over.
Thanks, everyone. I could spend another hour doing this, but I know we've got to make room for the next panel. Thank you. I really appreciate it. And thanks to everybody who attended today.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.